In this three-part series, you're gonna learn everything you need to know about trading options in the stock market. Today, we're gonna hop into the basics. We're gonna talk about what a call is, what a put is, how to go about executing an order, and dive into the fundamentals as to what an option contract actually is and how that could lead to your success in the stock market. So here's the definition of what an option is. In finance, an option is a contract which conveys its owner, the holder, the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. If that sounds confusing to you, don't worry, I'm gonna give you an example. An option gives you the right to buy 100 shares of a stock. Options give you this crazy leverage that you would otherwise not have. For example, if you buy 100 shares of Microsoft, that's gonna cost you $22,200. Now, on the other hand, if you buy one contract of Microsoft, it's gonna cost you $445. I never recommend as a beginner that you start with options. Yes, it gives you the ability to make more money with a smaller portfolio, but in return, you're taking on that much more risk due to this leverage. You're getting really 100 shares of the company you're buying for a fraction of what it would normally cost. Although I encourage you to see what works for you. Again, there's no cookie cutter formula you can follow. All right, let's talk about calls versus puts. What's a call? What's a put? Because you're either gonna be buying a call or you're gonna be buying a put. Now, a call means you think the price of the stock or the underlying asset is going to be going up. A put is the opposite, so you think the price of the stock or the underlying asset is going to go down. So a call is bullish, you think the price is going to go up, and a put is bearish, you think the price is going to go down. So this screenshot is an options chain. Now this is TD Ameritrade's Thinkorswim platform, the platform I use to trade. It will vary on what brokerage you're using, on what platform you're using to place your trades. So it might look a little different. I know Robinhood looks different, but I will show you an example of that later on in this video. But there's a couple more things you're gonna need to know before you make your first options trade. And that is in the money, ITM, versus out of the money, OTM. I'll show you what in the money and out of the money looks like on Robinhood's platform and TD Ameritrade's platform. I'm using Microsoft as an example. As you can see, the current price is $222.50. That is this share price right here. Now, this is a call. So if I'm gonna be buying a call in the money, that means I wanna be buying an options contract. Now, that's what these are. So in the money is gonna be anything below $222.50. So any of these contracts, the $220 contract, the $217.5, or the $215. These are all in the money. Okay, so what is an out of the money call? Now that is gonna be anything the opposite direction, anything above the in the monies, which is going to be anything above $222.50. These are going to be out of the money. The 225, the 227.5, the 230. Okay, so that's gonna be if you wanna buy a call, that's in the money, that's out of the money. So that's for buying calls, but what if we want to buy a put? Again, a put, you think the price is going to go down. So an in the money contract for a put is going to be on this side. It's gonna be anything above the 222.50. And then anything below the 222.50 is out of the money. So in the money, out of the money. And then if we hop back over to the screenshot of Thinkorswim, the left side is going to be calls and the right side is going to be puts. As you can see, put and then call. The contracts in blue are gonna be in the money and that's a call. So these are in the money for calls. And this bottom section right here is gonna be out of the money. Right now, all you have to focus on is the middle column. We've got the strike price right here, and then we've got the expiration date. All right, let's talk about the options format and how you actually read an option. So it's going to be displayed like this. There's going to be the stock, so Microsoft, the strike price, whatever price you think it's going to be, whether it's a call or a put, and then the expiration date. This pretty much means that you think Microsoft will be at or above $235 on the 29th of January. Okay, so that is the very basics of options. What are options? Calls versus puts, how you actually read an option, how it's formatted, and then in the money versus out of the money. Now that I've taken you through the beginner concepts and you've learned the basics of options, if you'd like to pursue trading, if you'd like to make money in the stock market, I just opened up applications for my mentorship group. Now, you can click the first link in the description below to apply to learn about everything that is included. But I will say you'll have access to essentially learn the entire process my whole system and the means that I've gone about personally finding success and consistent profitability year over year in the stock market. So again, the first link in the description below will take you over to the application for the mentorship group. And if you are accepted, I look forward to working with you and we can find success trading options in the market together.